Hello, good morning, good afternoon, wherever you are in the world, and thank you for joining us today. My name is Trevor Hall. I'm the host of the Mining Stock Daily podcast. You can find anywhere you get your podcasts, or we give you your morning briefing about an hour before the market opens, and then corporate commentary, market analysis intermittently throughout the day. You can find us over at miningstockdaily.com. I'm really happy to be joined here by some real heavy hitters in the junior mining sector. We've got management from NICOLA Mining, Seabridge Gold, and hopefully Skeena Resources. I know Walter Coles is scheduled to join us. A little bit of technical difficulties. It's the age we live in, so we'll see if Walter can join us here in a little bit. Just a few housekeeping announcements if you're new to this format from 6. There is opportunities for Q&A at the end of this discussion. You can present your questions in the Q&A chat box you'll see on the screen on the right, and we will see those questions come in throughout the webinar and the presentation, and we'll try to get to as many of those as we can within the allotted time. So let's just jump right into it. Peter Espig of NICOLA Mining. Peter, thank you for joining us today, and we'll let you give your 30,000-foot view.
Thank you. Just without spending too much time on NICOLA Mining, I'll just spend like 3-4 minutes going through a slide deck that we put together for this show. So NICOLA Mining is we're fairly diverse. We're a small mining company with a small market cap, but we've got diverse assets that do make us unique. We have operations, so we have operational cash flow from our milling and our mill site operations. We've got a 43101 on our copper asset, which is part of our M68 permit, and we have pretty good intercepts. We've got invested in a gold project called Dominion Gold, and we own the Treasure Mountain silver mine. So these are the 4 assets here. So as you can see at the top, we have the new Craigmont Copper, which is the old site of the historic Craigmont Copper Mine, which was the highest grade copper mine in the history of North America. We've got Treasure Mountain Silver, which is a fully permitted silver mine located 90 minutes from our mill site. And we have a mill site, a processing facility. We've invested approximately $30 million since 2012. We own the land freehold, and which is also unique in mining. And we, as I mentioned, we own 75%. We've invested in Dominion Creek, which we have a 75% economic interest. Here you can see where the assets are located. We've got Dominion Creek, a new Craigmont, Treasure Mountain, and the new Craigmont is the site of both the mill facility and the copper project. Here, I like this graph because what it highlights where our mill site is, and then you can see small gold projects located in the vicinity of our mill. So I kind of like to think of it like, these gold projects are like airplanes, and they need an airport to land at, and we are the only site in British Columbia that is permitted to receive third-party material at any time. We can receive the material by notifying the Ministry of Mining 10 days ahead, and then we can start processing. So here you see the mill. You can see this. It's a 200-ton-a-day mill that is expandable. The photo on the bottom shows the inside. The mill was built for expansion purposes, but as it is right now, we focus on 200 to 300 tons a day on our 900-acre fully owned property. And some of the copper assays that we've received back are quite prolific for British Columbia, and anywhere where we've got intercepts of greater than 1% over tens to up to 130 meters. And this is our silver project, which is a fully permitted silver mine located off the Coquihalla. So the mill was built to process material from our high-grade silver mine, and we continue to monitor silver prices. There's level 1 stope 2, which is still in situ, and that's something that we can review whether or not to extract it at some point in the future. But really, the upside here is exploration, and we'll be doing an exploration program. We've applied for permitting for 2022 to continue exploration, and we did an airborne survey, a LiDAR survey in 2021. And again, just to wrap it up, I think that NICOLA mining is a unique project in that we provide investors exposure to 4 different opportunities, 3 metals being gold, silver, copper. We generate operational cash flow, which minimizes dilution, and we've got upside in the 3 metals: copper, silver, and gold. Thank you.
Thank you so much, Peter. Now let's go over to Rudy Frank of Seabridge.
A brief reminder that I will likely be making forward-looking statements during today's presentation. So if you look at Seabridge, we've put together a portfolio of advanced stage and early stage gold and copper projects in the Western United States and Western Canada. Our 2 most advanced projects are KSM in British Columbia and Courageous Lake in the Northwest Territories. And our earlier stage exploration projects are Iskit in British Columbia, the 3 Aces in the Yukon, and Snowstorm. And this was by choice. In my career, I've been in the business for 40 years. I built mines that have been expropriated. Political risk is very real in our space. And by focusing on North America, you tend to reduce some of those risks. When my partners and I formed the company in 1999, the price of gold was about $260 an ounce. We believed, for various reasons, mostly from the macro perspective, that the price of gold would go substantially higher, which obviously it has, with gold trading near $1,800 today. Our goal back then is the same as it is today, and that's provide unique and unparalleled leverage and optionality to the gold price. And the way we do this is by growing our ounces in the ground faster than our shares outstanding. And as you can see on this graph, we've delivered on this concept. And it's not just about finding gold. In all of our resource categories today, we have 159 million ounces of gold. But in addition to that, we also have over 50 billion pounds of copper and over 700 million ounces of silver. In fact, if you look at the metal in the ground that's supporting our valuation today, the total metal value per share is over $6,000 an ounce. And we're trading today in the Canadian markets at about $23 a share. So when you look at Seabridge relative to the industry in terms of ounces per share, just looking at gold, we provide 5 to 50 times more gold ownership per common share than any other company in our space. And again, that was by design, by growing ounces faster than share count. And what this has meant over the long haul is significant outperformance in our share price relative to the gold price or the gold equities. The fact is, if you're looking for exposure to gold and leverage the gold price, Seabridge has a 22-year track record of outperforming gold and other gold equities. It's also interesting to note on this chart here, over the long haul, most of the better-known gold companies like the Newmonts, the Barricks, the Kinrosses, and others have significantly underperformed the price of gold. You would have been better off owning physical gold relative to stocks than any of those names, whereas obviously in the case of Seabridge, you are better off owning our shares. So in addition to our leverage to the gold and copper prices, what else can drive value going forward? Well, today at KSM, we're sitting with the largest undeveloped gold copper project in the world that is not only large, but also shows tremendous capital efficiency and has successfully gone through the permitting process with permits in hand. We also have 3 earlier stage exploration projects, any one of which we believe can be a company maker. Late last year, we acquired a new deposit at KSM called Snowfield that brought another 35 million ounces into the portfolio. Bought that from Pretium for $100 million in cash. And we're now in the process of updating our pre-feasibility study at KSM to include Snowfield. And we think that will show not only a simpler project to build, but also a project that's far more robust in terms of financial returns. And then last but not least is getting a deal done on KSM. We recognize that KSM as it sits today is too large for us to look at developing. The project will require in excess of $5 billion to build, And quite honestly, there's very few companies in the space that have the financial, technical, and social wherewithal to build a project the size of KSM. We are now in dialogue with a number of parties on KSM. The M&A market seems to be opening up here recently with a lot of recent deals being announced. A lot of recent deals specifically announced in the Golden Triangle where KSM sits. So bottom line is we have a 22-year track record of outperforming gold and other gold equities, and we have other drivers of value that should create shareholder value going forward. Thank you.
Thank you, Rudy. Now we head over to Skeena Resources and Mr. Walter Coles Jr.
Yeah, thanks. Skeena is also in the Golden Triangle, right next to Rudy's KSM project. Our project is called SK Creek, or at least that's our flagship project. We also have a smaller project called SNP. These are both past producing underground mines that operated in the 1990s. In the case of SK, through to the first quarter of 2008, it was shut down right in the middle of the financial crisis. These assets were, we optioned them from Barrick in the last couple of years, and we've since acquired them and own them both 100%. Our flagship, as I mentioned, is SK, which we're advancing forward and hopefully getting it back into production. Sorry about that. Let me flip back here. So we have a resource that we published this past summer. At SK, it's about 5.6 million ounces in the measured, indicated, and inferred category. Of that, we've converted about 76% of it into reserves. So you can see that on the top of the screen. 3.88 million ounces of reserves at an average grade of 4.6 grams per ton gold equivalent. So quite an attractive grade for an open pit operation. And we have also recently published a pre-feasibility study. You can see the numbers here on this slide. The base case using $1,550 gold and $22 silver gives us an after-tax IRR of 56%, a 1.4-year payback on capital, and an after-tax NPV of $1.4 billion. The other terrific advantage about SK is, as I mentioned, it's a brownfield project. It was an underground mine. Now we're redoing it as an open pit. And because so much infrastructure is already in place, our CapEx is pretty attractive at $381 million US. That's coming out of the pre-fees. As we move to the feasibility study, look, we all know inflation's been happening around the world, and we do expect to see probably a 10 to 15% bump in our CapEx as we go to the feasibility study. This is a project that will, in the pre-fees, was going to have a mine life of 10 years with 352,000 ounces a year of production. You can see what the production profile looks like right here on this slide. In the first 5 years, the average grade is 5 to 6 grams gold equivalent. And because the grade's so good, we actually have a production rate of around 450,000 ounces gold equivalent a year. And then the grade falls off in year 6, and you see that production rate drops down to 250,000 ounces. We're working pretty hard on exploration right now to try to backfill this mine life to get that production rate up and keep it at sort of like that 450,000 ounces a year by doing a mill expansion in year 6. And then also as we grow the resource, find more gold, which we think we can, we'll extend the mine life. So still lots of interesting growth opportunity to this project. Just based on the pre-feasibility study, where I mentioned 352,000 ounces a year annual production profile, it would be one of the largest gold mines in Canada. But not only does it have a size, as I mentioned, it's got grade, and you can see where SK sits on sort of a global ranking of open pit mines by grade at 4.6 grams per ton. It's truly an exceptional mine with profitability and margin of safety. Sorry. One of the things that is a hard thing to do as an investor is just figure out what's the value of an asset. And we have this situation where a mine right next to us, Brucejack, that was Pretium's only mine, just got sold. And Interestingly, last year, Brucejack produced 348,000 ounces of gold. It has about 3.9 million ounces of reserves. It's awfully similar to what Eskay looks like. We've got 3.9 million ounces gold equivalent reserves and a production profile almost the same as Brucejack. Big difference is Brucejack was in production. Eskay is probably still 2.5, 3 years from production. And you see that divergence in valuation there. Brucejack sold for $3.5 billion. Skeena's got a market cap of $750 million. Our hope is that as we bring this project into production, we'll close that valuation gap, which will be a lot of upside for our shareholders. Another wonderful thing about the Golden Triangle is we've got hydropower and high-grade mines, and so you end up with actually very green mines. Eskay will be one of the lowest producers of greenhouse gases per ounce of gold production of almost any large open pit mine globally. One of the last things I've mentioned is we're in Tahltan region, just like Seabridge. We consider ourselves very fortunate to be in Tahltan territory. They understand mining. They have excellent governance in place. We feel very fortunate they decided to make a $5 million equity investment into Skeena this past year. We were honored that they would become our partners alongside our shareholders. And I think it just reflects, what a wonderful place this is to have a project. Because if you find a deposit, you can get it permitted and you can get it built. And it's a politically stable jurisdiction, so much better than other places I've worked in around the world. It's really a first-class jurisdiction. And that's it. So thanks for the opportunity to present our company.
Thank you, Walter. Thank you, Rudy. Thank you, Peter. Okay, so let's get down to business. Once again, if you do have questions for the audience, for any of these gentlemen, you can put those in the Q&A section in the right. We may not be able to get to the project-specific questions, so if you have those, we can get those directed to the appropriate individual and hopefully have a follow-up discussion or quick answer that way. So do pay attention to that. Because today, the topic at hand is the past, present, and future for base and precious metals. So massive topic, and we now have 43 minutes to really hammer it down, gents. We got to get this done. So let's really get right down to business, and let's start with gold and the precious metals. You see really driving prices right now, or lack thereof?
Sorry, you faded out there a little bit, Trevor. Can you repeat the question?
Yeah, I'm sorry. I will actually shut off my camera. Hopefully that helps. So the question was, besides demand and supply, what are the main drivers for gold and precious metals right now, or lack thereof?
Okay. Well, you're absolutely right. For things other than gold, industrial metals, supply and demand do drive prices. But in the case of gold, it really is different. It really is a monetary metal versus an industrial metal. So what we see as the drivers of gold, first and foremost, the confidence or the loss of confidence by investors in central bank monetary policy. Second would be the stability or instability in the global economic and financial systems. And then the last, which I think we're starting to play out now, are the levels of debt and whether the levels of debt are manageable or if default becomes a problem. I think those are the three major drivers of gold, to the positive side and the negative side.
Well, Peter, we got to get you unmuted. There you go.
Can you hear me?
Yeah. Go ahead.
Okay. Yeah. Sorry. Yeah. And just to add what Rudy said, I think that if you look at the value driver of gold, I think a very important thing is the scarcity of it. I mean, you can take all the gold in the world and you can basically put it in a 27 by 27 meter box. And so there's not a lot of it. I think there was I don't know if there's a podcast called The Immaculate Conception, which I highly recommend. And it talks about pricing of Bitcoin and gold and how scarce they both are. And so, you have gold, and new gold entering into the market at 1.6% per year. Silver's at 5%, but inflation is right now over 6%. And remember that CPI inflation doesn't include housing prices. So I think we're seeing an inflationary environment where gold is really a stable metal when it comes to preserving your value or your wealth.
Yeah, I just add one thing to the discussion, sort of the elephant, and kind of a little bit of an elephant in the room is the impact of crypto currencies on gold. I think there has been some substitution that's occurred, and that people who might have put their money with gold right now are maybe sticking it with Bitcoin or Ethereum, and I think that's for right now it's the shiny object that's attracting a lot of attention, whether it's in the press or especially with younger, I think, wealthy investors. But an open question as to whether those vehicles will stand the test of time. And alternatively, I'd say it's a challenge to our sector, the precious metal sector, to figure out how do we sort of tap into some of those platforms. I mean, one of the things that I often think about is how stablecoin has attracted something like $70 billion. It's a cryptocurrency just pegged to the price of the US dollar. We haven't seen that kind of traction happen for like a similar vehicle for gold, some type of NFT pegged to the price of gold. I think that could be an interesting way, if it can catch some momentum, to attract some of that capital back into the precious metal space.
Walter, it's interesting that you mentioned cryptos because there was a little bit of a, flash crash here over the weekend. And sometimes that's what happens, but we didn't necessarily see a lot of that money flying from Bitcoin into gold. Well, because gold doesn't trade on the weekend, but it's an interesting time here. Just generally in the macroeconomic stage, as far as the cycle goes, we can all kind of put our kind of finger where we think the cycle is right now. But let's talk about this and what the price of gold is. It did increase quite a bit here over the last couple of years. Even prior to the pandemic, it was starting to make good runs. And last summer, 2019, exceptional run up to new all-time highs. Peaked, but it's been pretty tough correction here for the greater. What are we going on here? 16 months now, almost. What is your thoughts on that big move up to all-time highs last year and this really long-term correction? I guess we'll keep going in order here. So, Rudy, you're up.
Yeah, I think that price move from November of 2019 to July of 2020 was driven by two factors. One was unprecedented quantitative easing, extreme central bank inflation by increasing the money supply, and also during that time, a huge increase in public debt to fund the stimulus without a corresponding increase in economic output. And I think that's why gold had its big move during that time period.
Peter, Walter, you have anything to add on to that?
Yeah, I just to add, kind of combine the first question and the second question is that, one of the things that the investors need to understand is really the gold price and the silver prices are driven by derivatives. So, I mean, if you look at the derivative market, the paper market versus the physical market, it's for gold, it's about 200 times the size of the physical market of gold. And for silver, it's about 250 times. So most people trade paper rather than buying the physical. And what I see is Bitcoin. Remember that Bitcoin is kind of emerged as a currency, but there's no derivative side to it. So you're seeing this maturation of cryptocurrencies, and I think that they're going to kind of become closer and kind of mirror how crypto, specifically Bitcoin, how it's going to be more correlated with the prices of gold. And people will be able to go back and forth. But the mainstream investment banks haven't really figured out how to do that. But when they do, I think that that's going to be a major driver of gold going forward.
Yeah, I don't have anything to add. I think Rudy and Peter nailed it.
Okay. Well, that was kind of the past. Let's take it to the present. We're kind of continuing to sit around this $1,800 level here on the spot price of gold. We had a nice little move up. We thought it was pretty positive, but got slammed back down last week or the week before. Where do we, is this kind of seasonality with gold, or where do we go from here? Is there anything to look for?
I think we go much higher. I mean, investors, for some reason, still have confidence that central banks, that they'll be able to tighten, they'll be able to control inflation while the economy continues to grow. We don't think that's the case. I think the debt levels right now make regular hiking cycles impossible. And when markets realize that central banks can't manage inflation, or more likely choose not to manage inflation, gold will go to record highs. I mean, our shareholder base is comprised of a lot of people that are smart in the gold space, trading currencies and commodities. And I think the common view amongst our investor group is we will see all-time highs in gold next year to levels that will surprise a lot of people, because the Fed's not going to be able to taper everything and start to raise rates without blowing up the markets. There's just been too much punch given at the punch bowls over the last few years, and thinking you can just remove that without any consequences to the global financial system and asset values is ludicrous.
Yeah, go, Walter. Do you want to? I'll let you jump in.
Yeah, I would say, looking at gold and how it's been flat, I think is to some degree, an attractive aspect to it. It's not nearly, it doesn't have these like 20% swings that Bitcoin has like over a weekend. I think if you're looking for a store of wealth, something that fluctuates to that degree, that's not a really that doesn't give you peace of mind in my mind. So, to some degree, I think that gold's sort of proving out its worth as a store of wealth, in the fact that it has been relatively trading within a pretty tight band here over the last few months. I mean, the thing that puzzles me is the darn gold equities, because I think gold's held up well, but the gold equities have been under a lot of pressure, kind of across the board the last few weeks, and I don't have a good explanation for it. Maybe Rudy, you can share some insights on that one. But because you would think the equities, would track the gold. It's almost like the equity investors are really frightened about the possibility of the tapering, getting done here in March, and then rate hikes coming. I don't really have an answer for it.
Yeah,
I would think that I agree with Rudy. Price of gold's likely to go up, and then the equities will kick back in and grind higher as well.
Yeah, Walter, I'd like to add to I think that the market. So there's a difference between the holding physical gold and actually holding mine stocks, and I think part of it is that a lot of investors have kind of lost confidence in the capital markets in bringing projects into production. And so, the market's driven out of China and India, where they want to hold the physical gold. That's a driver of the valuation of gold. But I agree with both of you in that, I mean, if you look at it from a macro fundamental, so we've got global inflation. I just read an article on the Federal Reserve that September, October were the highest months of gold coin purchases in the United States since 2010. So you're starting to see this accumulation where people are starting to take the gold, the physical gold, because it's the only metal that you can really store a lot of value in a small space, right? Like you can't do it with silver, you can't do it with any other metal. Gold is very unique that way. And so now you've got inflation, and you've got you've got inflation, but it's also triggered by global population growth. So there is no way, gold is going to go up. I mean, I think that's inevitable unless people try and manipulate both, the paper stocks. But ultimately, I think the physical properties and the physical value of gold is going to drive up the valuation of the gold, especially the physical. And then I think that mining stocks will ultimately benefit.
I have a different take on mining stocks and why there's not a lot of interest in them at this point in time. I mean, I actually did a presentation at the Jim Grant conference in New York a few weeks ago. Jim asked me to come in and speak about why have gold stocks not kept pace with the price of gold over the past 2 decades. And if you look back at our industry, we could be the worst allocators of capital of any industry on the planet. If you look at the stupidity of the deals that are done by the majors and the timing of those deals. In fact, we have one graph in our corporate presentation that shows the net cash flow for the entire industry year by year by year over the past 30 years. Well, gold went from $260 to a recent high of over $2,000 an ounce. Our industry lost money every year in terms of net cash flow. And it wasn't until shareholders actually revolted and said, we need to start seeing return of capital to shareholders before we will continue to invest in you. And what has the gold companies done? Well, they've actually curtailed exploration expenditures and they've cut back on CapEx. So instead of trying to drive for their future and build for the future, they're basically cannibalizing themselves now, and their reserves are dropping and their production is dropping, and they continue to issue share after share after share. So I think to get investors back in our space on the equity side, we need to do a better job in terms of allocation of capital and doing smart deals instead of dumb deals like we've done. And maybe our industry has finally learned that. I sure hope so. But going forward, we need to see investors come back into the space. I go out and do a lot of presentations, and most of the people are convinced that the price of gold is going to go higher, but they're kind of leery about investing in gold equities because of the track record of our industry.
Yeah, but Rudy, and all your points are correct, and I think that the investors need to feel confident that projects are moving forward, right? So there's been the mining market, especially the junior market, hasn't done a good job in raising capital and then bringing those projects to fruition. And that's what really the market needs to feel comfortable to say, you know what, like we can invest in mining stocks because here's what the resources are and they're going to bring those into production and we're going to benefit from that. Because without that, there really is no production.
But at the end of the day, Peter, production really doesn't matter in the supply of gold. As you said, every ounce of gold that was mined for the beginning of time is eventually available as supply. So the additional 2,500 tons we bring into the market every year is de minimis compared to the 160,000 metric tons of gold that sits above ground supply as above ground supply already.
Yep.
Can I jump in here and ask a question anecdotally, just based on my age and being relative, having an understanding of people going and investing in such things as cryptocurrencies, tech stocks. That generation, my generation, wasn't necessarily interested in gold back in 2011 because we typically had no money to invest at that time. So how do we, are the gold miners improving those fundamentals of business based on lessons learned the last go around that my generation just wouldn't kind of be acclimated from it and had the chance to learn from?
Yeah, I think that the industry is trying. I think the industry, got a shot in the bow a few years ago when the big players in the gold space revolted against them. I remember there was a presentation, Walter, I think you were probably there at the Denver Gold Show, where the Paulson Group got up and just lambasted the whole industry in terms of return on capital. And I think the industry is trying, but they've got to prove themselves. I agree with you. Companies like Walter has, in terms of a company that is undervalued relative to peers, that's trying to put a mine into production that'll be a great mine. I think there's tremendous value there as an investor going into that, especially if the price of gold goes a lot higher. But I think the investing public will be a little more particular in terms of looking at the right companies to invest going forward and not just doing a blanket. I think another thing that's hurt our industry is the ETFs that have been created, which then in themselves is just a poor way of trying to play gold equities because the way they're managed in terms of selling their winners and reinvesting in their losers. Not something that builds value over the long term.
Yeah, and I think the market is going to understand more and more that probably the most important thing when you analyze or look at which companies to invest in are going to be dictated by jurisdiction and management, because gold, when you look at gold grades and you look at costs, I'm not saying they're fixed costs, but they're understandable. But the political jurisdiction and the stability that will allow you to get the proper permits and provide you safety once you start mining, and then the ability of management to lead a project, those are I think the two biggest factors in which companies to choose to invest in going forward.
Totally agree.
I suppose that there's a big discussion on gold. Obviously, we've only scratched the surface here. We could go even deeper, but we should go hit on the base metals as well. Especially, we talk about this big basket of base metals. Obviously, copper is always kind of the darling child of the base metals complex. So we'll stick with that. But I do want to talk about the general base metal environment here before we jump right into copper. Walter, let's start with you, because you got a big base metal project as well on top of that small gold project you have up there.
No, I don't. What do you mean? I mean, SK is all gold and silver.
Oh, it's gold and silver. I'm sorry. I'm sorry. Rudy, you got a big copper.
Well, I think Peter has a bunch of base.
So, Rudy, let's start with then and talk about the base metal.
Well, yeah. So we have a lot of copper, and I think anything that's going to be needed for the green energy initiatives going forward are metals you want to own. I have no doubt that cobalt and copper and even lithium and those metals will go a lot higher. In the case of copper, I mean, the amount of copper that's used in electric power vehicles or in wind turbines or in solar panels dwarfs the amount of copper that's used for more traditional energy sources or combustion engines. And if you look at the supply and demand fundamentals in the copper market, you have to like copper going forward. I mean, these analysts tend to build in their spreadsheets mine supply very quickly without realizing how difficult it is to bring a new mine into production, how long it takes to get a project permitted. And when I look forward on the copper market, I think that the demand is going to continue to grow while the supply side is going to be challenged. I mean, I look at reports that were done recently by Goldman Sachs looking at the deficit we're going to see in copper over the next 10 years. I see copper going through $10 a pound over the next several years as a result of the green energy initiatives. And the ironic thing is the same groups that are screaming for green energy initiatives are the same groups that are saying we don't want any new mines built. You can't have both. I mean, if we're going to go into electric powered vehicles, we need copper, we need lithium, we need cobalt, we need all those other metals that are consumed by those by that demand.
Yeah, just to put some things in perspective and to talk about the true drivers of copper prices, and Rudy mentioned that there's going to be a copper deficit, but just some stats here when it comes to what are the drivers of copper. You can start with population growth. So right now we've got a population of around 7.6 billion. Well, by 2020, like 2100, that's going to be 11.2 billion. So we're going to add over the next 70, 80 years, 3.6 billion people of population globally. And the real driver of copper is the middle class. I mean, I know we refer to it as the green metal, which it is, because it is the greenest metal when it comes to carbon footprint when in mining, but the reality is it's also the metal of the middle class, because every house that is built requires copper wiring. I mean, that's the use of copper. So if you think of right now, there's 1.6 billion houses in the world with an average, the average number of people living in a house is 3.4. Now, by 2100, we're going to need another 1 billion houses. I mean, it's the numbers are staggering. So that's why, as Rudy mentioned, Goldman Sachs came out with a report that said we're going to be 9 million metric tons short of copper supply in the next 5 years going forward. And that gap may continue to increase, because what we're seeing in China, so by 2030, 70% of China is going to be labeled as middle class. In India, you're seeing an exponential growth of middle class. So you're going to have 70% of the global middle class based in India and China. And one characteristic about middle class is that they can afford to have a house, whether it be, it doesn't have to be a large house, but it's something where a family can live in. And that's why you're seeing, like, if you look at the global drivers of copper value, I mean, transportation, which is electric vehicles, is only 12% of the requirement of copper. It still is house construction, consumer goods is 20%, where, as people, they buy cell phones, computers, wiring, television. So the demand on copper is high, and it's going to continue to get higher. And I agree with Rudy. I mean, $10 copper per pound doesn't seem too extreme.
And let me just add to Peter and Rudy's comments. They talked about the demand side. I think there are risks on the supply side. Peru and Chile are the two, that area of the world produces, I think, over 40% of the world's copper. And if you're following the politics in Peru and Chile, they're swinging to the left, and they're becoming somewhat hostile towards mining. So I think there are real threats that, the global dependency on copper from those two copper supply from those two countries is at risk. And I think that highlights the opportunity for BC, British Columbia, to step in there and become a significant global producer of copper. And Peter and Rudy's, companies are at the forefront of I think, leading the charge there.
We've had a lot of
just to add, Walter, because and it's not just political instability. I think, for example, Indonesia announced this week that in the next 2 years they're actually going to stop copper exports. For the reason being is it's actually becoming more and more of a strategic metal, from the perspective of the country. So it's going to become in a way like the commodity, the precious metals of base metals, and countries are going to maybe even restrict exports, like Indonesia has announced this week.
Let me follow up with you guys about on this copper side and maybe short-term concerns. I know there's this discussion out of China that there's slower growth in China that might be reported in Q1 of this year. Higher energy costs have forced some smelters to shut down in China that we're hearing. Lack of tradable metal exchanges in Shanghai. Does all of this concern you, or is it just currently just noise that you're looking past?
Yeah, I think a lot of it's noise. I think China clearly has decided that the boom must continue for social stability reasons. And as a result, they're going to get back to consuming the metals that hopefully we will be producing. So I think it's just noise right now. You look at the debt that was created in China over the past decade or so to fuel the growth. They've got to keep that ball rolling. And as a result, I think they will continue to consume lots of metals that are required. I think that's why China is moving to Africa, in terms of looking for new sources of metal and as another trade partner. They definitely need to grow their middle class, and they'll do so by continuing the economic boom that's being funded by the government.
Yeah, and economic growth. Remember, Chinese economic growth. China is a manufacturing country focused on exports. So yes, even with the slowdown, that doesn't it does affect some copper demand, but the reality is that it's the growing middle class that is the real driver here. So you've got, in North America, you've got two key fundamental drivers. You've got electric vehicles and you've got wind power. And, it's becoming more and more, rather than electric power or solar power, wind power, which utilizes more copper than solar power does, is becoming the green energy provider of choice for North America. Then again, in China and India, you've got this growing middle class, and it's the middle class that they're still consumers, and they're going to be consuming, they're going to be building. And so I think that when people talk about slowdowns, the slowdowns are like 3 months. It's a 3-month outlook, but that doesn't have anything to do with the long-term economic drivers or macro drivers that are going to be driving the metal prices.
We got about 14 minutes left until we need to close. So we should probably start getting, we have gotten a few questions coming in. Not surprisingly, there's more than a couple questions about directed towards Rudy and KSM project, questioning about a JV partnership. So I guess we'll just kind of jump into there, Rudy. I think somebody named P. Roth question was, given the rising importance of copper in the new electrified economy and the size of KSM in the jurisdiction like BC, wouldn't a major from the list with their much bigger market caps and free cash flows be a much better JV partner than, say, potentially a big gold producer?
Yeah, a great question. It's a question I get answered quite a bit. We've spoken many years about our need to bring a partner in. And when we started that process, we were known more for the gold at KSM because we had not yet found our two higher grade copper deposits, namely Iron Cap and Deep Kerr. So most of our initial discussions was with the larger gold companies. As we brought Iron Cap and Deep Kerr into the mix with a lot more copper, I think since 2016, we added 30 billion pounds of copper at KSM in all resource categories. So you're absolutely right that we're not just talking now with the big gold mining companies, we're also talking with the big copper companies. And I wouldn't be surprised at the end of the day if actually it's a syndicate that co-develops the mine with us, perhaps a copper company with a gold company, or a copper company with a financial partner, or a gold company with a financial partner. I think there's no question that projects like KSM will get built, and it's probably going to get built more for its copper than its gold because the world needs copper. So it's nice to have that copper there as a byproduct credit coming out of the production. What I keep saying is nobody wants to get a deal done more than I do, believe me, but it's got to be with the right deal, with the right partner, under the right terms. We only get to do this once, and it's got to be the right deal. So stay tuned.
Okay. Walter, this is actually a question of my own because we haven't really talked about the silver aspect here. Silver kind of crosses that boundary between monetary metal and industrial metal as well. But talk about silver as a component of the metals prices moving forward, and how does that play into this kind of whole narrative?
Yeah, I mean, silver's traditionally viewed as sort of like gold on steroids, and at SK right now about 30% of the economics on our project are in silver. So, and just anecdotally, in history going back to the 1990s and early 2000s, silver was more than 50% of the economics coming out of SK because the silver price relative to gold was much higher. And it's sort of, I think if gold catches a strong bid here, like I think Rudy and Peter and I all think it will, I think there's no reason not to expect, just based on history, that silver will likely outperform gold.
Peter, speaking of silver, there's a question here for you, talking about and Barry has a question about how much will you be drilling and how much capital will you be allocating?
Sorry, I couldn't hear you, the question. Like, was the question just the end one?
Yeah, the NICOLA, your silver exploration.
Okay.
How
Yeah.
much will you be drilling?
So we've applied for, we are in the process of applying for a multi-year permit application for Treasure Mountain. So I think Treasure Mountain has two key components that make the project up. So the first is a permitted mine. And so we have the permitted underground mine where we could consider reopening it and extracting one of the stopes, which is level 1 stope 2. And so that would bring in cash flow. Now, when it comes to, what is the exploration side, or how much do we expect to allocate to exploration? The difficulty with that is the following, is that, yes, we intend to do exploration on the backside of the mountain. That is one of our top priorities. It's the top priority for Treasure Mountain. But how much we're going to allocate to the exploration depends on the success of the beginning of the exploration. Because, if you're successful at the beginning, then you're going to increase your drilling and your exploration, project, or your budgets. But it's a difficult question to answer until we've actually started exploration on the backside. We've done a lot of soil testing. We've done sampling, grab samples. We know where the vein is. It's well mapped out. It's just, it's difficult to give a budget right now on a program that is really greenfield.
Jesse has put as the question, I love this question because this goes back to the macro, which will affect all of the metals. But sticking with gold, the question is, does possible rising interest rates worry you? I might just chime in here that they don't worry me because I invest in gold, and gold historically has nice moves after rate hikes. So I'll just add that a little backdrop. But I'll let you guys jump in here and about these interest rates and the talk of hiking. Does that have any concern?
I think you're absolutely right. If you look back historically, gold has done extremely well in the past 3 tightening. It's just the fact. I think it might be because inflation expectations are rising. I think what's more important to determine the gold price is the real rate of interest. When you look at factoring in inflation, and gold tends to have its biggest moves when the real rate of inflation is negative or more negative than it is today. And I think that is in our future, because I think the Fed has finally admitted that inflation probably isn't transitory, that it's here for a while. I think they're going to have a hard time combating it going forward. And I think because of the debt levels that we now see in the U.S., people are not focusing on an important number called the debt to GDP. Historically, over the past 100 years, it's been about 70% debt to GDP in the U.S. Only once in history did it get above 100% until recently, and that was coming out of World War II. And what the Fed did back then was they let nominal GDP run hot while curtailing interest rates through yield curve control. They couldn't let the interest rates go higher. You're now at a situation where debt to GDP is at 125%, highest it's ever been. And, the government is going to have a hard time raising rates effectively without curtailing real growth in the economy. They need real growth in the economy in terms of nominal GDP growth to offset, the debt to GDP. So I don't think the Fed's actually going to be in a position to raise rates. I think they're going to kind of be stuck where they are now, maybe a little bit higher, but they can't do much against that because they've got to put their genie back in the bottle, which is debt to GDP.
Yeah, I would agree. I mean, I spent quite a few years in Japan, and Japan functioned very, very well with a debt to GDP in the high 100%. And so it's workable. I think from a macro long-term perspective is that, one thing about US dollar, Canadian dollar, and the euro is that the countries continue to print them. And so you've got, on the US side and the Canadian side, and we see this in Canada. I mean, Trudeau continues to print Canadian dollars. And so what that does is it devalues ultimately the value of your currency, whereas gold doesn't have that. Gold is there's a very clear finite number of ounces that enter the market every year. There's a very finite number of ounces of silver that enter the market every year, and it's below the inflationary rate. And I think that there's a difference between the Fed interest rate, which it becomes very difficult to raise, because then you cause housing, the banks to default, or people to default, because banks are going to have to raise their interest rates on housing. And then you go back to 2008, where you have another crash of the housing market, and the countries just can't afford to do that. They'll print more money, but what that bodes well for gold prices.
Yeah, I just add a couple comments. I think the Federal Reserve is in a rock and a hard place. If they, they may want to start raising rates next year, but how much courage are they going to have if the stock market takes a dive? Are they right back to cutting rates again? Even when we have, this sort of, sustained non-transitory inflation environment. And then the second question I would ask is, if they do start to raise rates and the yield curve starts to go up, how do governments manage all the interest cost of higher, if bond yields are going up and the Fed or the Treasury comes to auction off, a huge slug of 10-year bonds all at higher interest rates, that starts to eat into the government budget. Just the interest service cost starts to threaten, starts to take a bigger slice of government spending. So it would seem like there's a lot of incentive, or I guess the harsh reality of it is that, I doubt the Fed can really raise rates aggressively in a sustained manner.
Yeah, I would agree. And you brought up, Walter, a really good point on the cost to the government of having higher interest rates. I remember reading one time that Japan, to put it in perspective, at 0.16% interest rate, 20% of the federal government's budget is servicing the interest rate. I mean, it's quite significant. So, raising the interest rate by 0.1%, when you look at it from a U.S. budget, is massive, and that's not easy to do.
All good points, gentlemen. And I might just add, this is going to be an interesting week, because here in the U.S. we've got inflation numbers coming out later this week, Fed meeting next week, so we'll see what they all say, if it gives us any direction. Also, public service announcement. The tapering doesn't mean that their bond purchases have stopped. It just means they're not buying as much as they did last month. So we'll see. We haven't even gotten to an actual rate hike, hard, this is what they're going to do type of discussion. It's just all speculation at this point. Thank you so much. That's really kind of all the time we have for today. So Peter, Rudy, Walter, appreciate your time, appreciate you coming on to the show and giving us your insight. And I guess that's it for me. I'm Trevor Hall, and again, have a great rest of your day, everybody, and a wonderful weekend. Happy holidays.